qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Online, on radio, on podcast, this is the Get Ready for the Future show. Welcome into another edition as we help you discover, protect, and share true financial independence. As always, we are glad to have you along. 2 weeks into the new year, January 2025. My name is Scott Inman, along with GenWealth co-founder John Shrewsbury, getting us kicked off today as we get set to answer your questions. And John, I want to start here. I mentioned 2 weeks into the new year, and people make those resolutions. And there's this television ad that's been on nonstop during the football games that talks about National Quitters Day.
Yep.
That I think is it a week or 2 weeks into the new year?
I think it's on a Friday or something like that, maybe a week or two into the deal that you get all charged up during the holidays. And, you eat too much and you go, I'm going to hit the gym and all that. And you go in there and went, oh, this is real work. I'm done with this.
Yes. I think the TV ad has a girl running. It's for an Apple Watch, I think, if I recall. And the girl has an Apple Watch that is there to motivate her, right? And she can check her steps. She can check her heart rate. She can check her progress. And I think about that in terms of discovering, protecting, and sharing true financial independence. If that was your New Year's resolution, and I don't really like the idea of resolutions, to resolve to do better. That seems a little weak to me, quite frankly, because I think that's why people quit, right? It's like, I'm going to resolve to do better, but I'm really not going to make a plan to do it.
Right.
I think it's about setting New Year's goals. What are you trying to accomplish? And you think about this TV advertisement that we were just talking about. Apparently the character in that ad was trying to either exercise more to lose weight or to be healthier, whatever the goal is, and the goal was being tracked on that watch.
Right.
You think about the analogy to what we do here at GenWealth.
Yeah, you have to be on track and be tracking what you're doing in order to get there. What gets measured gets done.
Yeah.
And I think that's where a lot of people fail financially is they don't measure. They don't want to look at it. They just want to kind of hope everything works out. Well, hope is not a plan. Yeah. There is no plan that ever comes together just on the basis of hope. Now, do you need hope? Yes, you do. But you also need to put action to that hope. You need to track that action and make adjustments along the way. And that is the essence of being financially independent, is having that plan to do that.
Yeah, and it's the difference between a general plan and a specific plan. When you think about a specific retirement plan, you have exact numbers of what you're going to contribute, what you expect to grow or how you expect it to grow and where you expect to end up. And most importantly, what kind of income you expect to have on the day you retire that's going to last the rest of your life. So that's the specifics. And we know life is going to happen, right? I mean, we're going to have to change that along the way. But having a plan and working with a financial advisor allows you to go, hey, I've got a life decision to make here that's different than what I came in with. How is that going to impact the plan? And you're able to adjust along the way and track your progress towards true financial independence.
Absolutely. And let's be sure that we understand that true financial independence is not something that everybody gets to attain. It is the folks that are disciplined enough to go in, sit down with an advisor, take the time to work through things, and then make those adjustments along the way, because life is not static. Life is not constant. There's a lot of change in life, and you've got to be able to pivot with that change. And that's where a financial advisor really comes in to help you to understand, okay, if I need to spend $40,000 or $50,000 on something, how is that going to affect my financial independence situation? Am I going to wreck my financial independence by making this particular decision? Or am I going to be okay? That's just one small aspect of how financial advisors influence financial independence.
So it was about 2 or 3 years ago, we made a change in the format to the Get Ready for the Future show, and we decided to make it all about your questions. And that's what we've been doing, and we're going to do it again this year. So let's dive into our first question of the show today. It's from James. He sent it in via text message, and he writes to us, both myself and my sister are financially stable and don't need any kind of assistance. Does it make sense for my wealthy mother, a recent widow, to take out a significant life insurance policy? James, thanks for that text message, and our condolences to what may be the death of your father there if she is a recent widow. But we certainly are very fond of, and necessarily so, taking that question and bringing a few back at you, because obviously when our viewers and listeners ask a question, we're only getting part of the story, right? It's going to be best if you come into the office and have a full discussion that may take a couple of hours. And anybody who is listening or watching that is a GenWealth client, they know that that's a process, right? It takes a little while to get the full picture, but let's do the best with what we've got. So, I think what we're going to get to here is how much wealth are we talking about? We're going to have to talk about this from an estate tax perspective, potential estate tax perspective, and also from an inherited IRA perspective. So we'll get there. But when you think about life insurance in general, this has evolved, John. I think for a long time, the only thing that we were looking at for people was term life insurance, because you only need life insurance for a certain season of life while you're financially vulnerable, let's call it, overall. Right. If something happened to you and the goals would not be set, the mortgage would not be paid, there might be even a struggle to maintain lifestyle or even dignity for the surviving spouse. And that's still very important, and that's still primary to what we do. But because of a change in legislation and potential changes down the road, life insurance kind of has taken on a little bit of a new meaning. Yeah, and I still think that we have to be cautious about life insurance, because it's one of those things that there are legitimate needs for life insurance in a lot of different cases, but sometimes the discussion is much more of a contrived excuse for making a sale of a life insurance policy that somebody may or may not need. So let's be clear about that. But at its core, Scott, you hit on it just a moment ago. Life insurance is really for income replacement. The most vulnerable people with life insurance are your typical young family, a couple of kids, a house mortgage, debt up to their eyeballs and all of that. If the breadwinner or one of the breadwinners of that family were to die and suddenly there is a major interruption of income coming into that family, that's a problem. Now, in the case of James and his mom, doesn't seem like that's even remotely the case. I would assume that his mom, because she is financially independent, that there's really no big income risk or anything of that nature. So the income replacement aspect of life insurance for James's mom just really doesn't exist. But that's really not necessarily the end of the story. I think you have to ask, first of all, where is this wealth located? Yeah. What kind of wealth is it? Is there liquidity with this wealth? There's a lot of things here that we've got to kind of unpack to be able to accurately answer this question. So let's take the where is the money piece to this question. So if there is a substantial amount of assets in retirement accounts like 401ks and IRAs that your mother has on her own or has now become the owner of because of the recent widow status that she has, and you are telling us that you and your sister are financially stable, so we're going to assume for purposes of answering this question that there are two siblings. That's it, right? And y'all are going to be the two recipients eventually of all this inherited wealth. So if there's a substantial amount in an inherited IRA after your mother passes, let's keep it easy and say there's $2 million that's going to pass on, and you and your sister each are going to receive $1 million in inherited retirement accounts. Pre-tax. Roth IRAs would not qualify here, or they would qualify for the rule, but they wouldn't be a problem like what we're getting to. The new rule, and we say it's new, it's not all that new anymore, it's about 5 years old actually, the Secure Act that was passed in 2020 requires that the inherited IRA dollars be completely withdrawn over a 10-year period. So if you inherit $1 million from your mother, you're going to have to take all of that money out and expose it to taxes over the next decade. So that's at best $100,000 or so per year, which doesn't even account for growth in the account, which could potentially be great as well. So you're going to have to take that out and stack it on top of your current income. And you've told us that you're financially stable. We're going to assume that you got there primarily or partially because you're a pretty high income earner. So $100,000 stacked on top of what is already a pretty nice income could be a third or more in federal taxes due every year along the way. So in essence, the bottom line here is, James, you could potentially be looking at getting hammered by federal income taxes if you inherit all these dollars while they are still inside of the IRA wrapper. So one potential use of life insurance is to have a life insurance policy, which the death benefit is completely tax-free, that allows you to compensate for paying all those taxes.
Yeah, and I think that, Scott, when you kind of walk through that whole scenario, you have to think about what is the impact of that next dollar that somebody is going to get in terms of an inheritance, maybe a withdrawal, a mandatory withdrawal from an IRA or whatever the case may be. If you are, let's say, in the 35% tax bracket, it might push you to the 37% tax bracket. And there's a lot of things that happen inside the complex tax code that can alter the amount of tax that you actually pay on the upside as you are taking this. So it's a very onerous type situation. And so if you've got something like a tax-free death benefit from a life insurance policy to cushion that blow, or if mom just wants to go spend that money and leave the life insurance to the kids as their inheritance, then that could qualify for a tax-free distribution of those assets to the kids, as opposed to a much reduced taxable distribution of those same IRA assets.
And finally, before we move on from this question, the other piece, if we're talking about a different level of wealth here, because this doesn't really apply to many people right now because the exclusion is so high, but if her wealth, if her estate is going to be over $13 million, and that's the current law, then there could be some dollars exposed to an estate tax, or the death tax as it so often gets called. And that's a different situation too, because you may not inherit near what you thought you were going to inherit if you have to pay the 40% estate tax. There are strategies there, including life insurance, John, that could be helpful to, again, provide a tax-free death benefit to pay estate taxes. There are also strategies in place like an irrevocable life insurance trust that we don't have time to get into here, but you could talk to an advisor, an attorney about that. That's a way to potentially pay those estate taxes. We don't know if her wealth exceeds that, but the other piece to that is we also don't know how big that exclusion is going to be in the future.
Yeah, the estate tax is up for grabs, so to speak, during the Trump administration. I would suspect that they will be hard pressed to get Donald Trump to sign anything that decreases the threshold and exposes more people to estate taxes. But you never know in politics.
Yeah, and that has been as low as $1 million in recent history. We don't see it going that low again, but that is subject to legislative risk, so it's always good to be aware of that. So bottom line for James is, I don't know if there's a need for life insurance. There may be a preference for life insurance if you want to deal with the tax situation. Hey, we have a special offer in the month of January from GenWealth Financial Advisors. We are offering a free Social Security analysis. If you're wondering when is the best time to claim your Social Security benefit, how does it work into your overall retirement income plan? Well, now's a great time to do it. We can give you a Social Security analysis for free. All you have to do is call us, 866-653-PLAN. That's 866-653-7526, or email info@getreadyforthefuture.com. Next, it's Gary from Russellville. I'm 59 and expecting some health issues in my future. I have about $2 million in various accounts. Should I self-insure, or should I get some sort of policy? If I go with a policy, what kind should I look at? All right, Gary, well, let's ask a question back to Gary here. John, the first thing we need to clarify is, what type of health is he trying to insure?
Yes, if you're talking about just regular everyday health insurance, that's one issue. If you're talking about something that would cover a chronic long-term issue, that's a completely different situation. Obviously, everybody should have some form of health insurance that covers doctor's visits, hospitalization, things of that nature. But it sounds to me like that Gary is talking about things that would cover home health care, nursing home care, things that you're really not going to find coverage under your normal health plan. And if that's the case, then Gary has some decisions to make.
Yeah.
$2 million, Scott, really is kind of in that kind of no man's land, I'll call it, in terms of whether you have enough wealth to self-insure against a major long-term care issue.
Yeah. So first of all, I think Gary needs to really work towards building a retirement income plan to see how much of his $2 million is going to be needed to sustain everything else, right? We're looking at that health problem, the long-term care component of that, and it needs to be done holistically. What are you going to need to pay your bills? Do you have a big mortgage? Do you have a lot of debt? Make sure all those boxes are checked, and even to the point of discretionary income, what are you going to do in retirement? So your lifestyle is set, and we may not need all $2 million of your assets to provide that for you. So that's the determining factor of if there's going to be money on the sidelines that is not needed for your retirement income that you could use as a self-insured long-term care bucket. But that also is subject to change from other things that might happen as well. So you do have to be careful, as to John's point about no man's land, of assuming that this is going to be enough and I'm just going to self-insure.
Well, and you also, Gary doesn't say whether he's married or not.
Yep.
And you have to think about the support of the, I'll call it the non-impaired spouse.
Yep.
If someone has to have home health care or nursing home care, that spouse also has to have living expenses. And so you walk this very fine line trying to depend on your your retirement accounts to provide for all things in that situation. And that's where the long-term care insurance comes in. Long-term care insurance is designed to step in and pay the bills or offset some of the cost that nursing home care would impose on a family. And that will leave the assets intact for the non-impaired spouse to continue their lifestyle. There are things that they require and desire in their lifestyle, in addition to taking care of their impaired spouse. So it is a very complex situation. And Scott, there are a couple of different ways that you could approach this. One we don't particularly care for. The other we actually do like a lot. We're not big fans of individual standard long-term care insurance, because rates go up on that. There's a paper chase that goes on as far as the claims program is concerned. We really do like the idea of using a hybrid life insurance policy that uses the death benefit as a pool of money that can offset long-term care expenses.
Yeah, so the key there is you have a level premium. So day one, your cost is the same as 20 years into that because it is a life insurance policy. It may start out a little bit higher, the premium on day one, than the traditional long-term care policy, but you have to understand that's because somebody is getting paid. You're buying a pool of money that, let's say it's $100,000. If you drop dead suddenly and don't need long-term care, then that $100,000 is going to go to your beneficiary. Could be a spouse, could be anybody you name, of course. If you need some or all of that $100,000 to provide yourself with long-term care coverage or meet long-term care expenses, then you would begin to draw off of that pool of money. When it's gone, it's gone. But if you don't use all of it and pass away, then you do still have a death benefit residual there for your beneficiary. And I think the other key piece and why we like it so much, John, is that it does not require you to be in a nursing home and have nursing home care. You only have to check a couple of boxes. If something happens to you and you cannot conduct 2 of the 6 activities of daily living, then you're going to be on claim and you're going to begin starting to receive a monthly check, monthly income, a preset amount before when the policy is issued. And that will be able to go to be utilized any way you need it to be. If you need somebody to pay, you need to pay somebody to come over and cook your meals. It can be used for that. So it can be, as you're fond of saying, stay out of the nursing home insurance.
Yeah, and I really have to caution people not to fall into the thought process of, that's not going to happen to me. Yeah. Well, here's the statistics. 70% of the people listening to this broadcast right now, 70% of anybody in America will need some sort of long-term care in their lifetime. Now, that might not mean I'm going to be in a nursing home. I get that. Most people are very resistant to that idea. They'd like to be cared for at home. So let's talk about what that cost is. Nationwide, the cost of home health care runs about almost $6,000 a month. In Arkansas, it's a significant amount less. It's about $3,700 a month. But just think about having another $3,700 bill that you have to take care of. Financially, how would you do that? And, you know, Scott, when you think about $2 million of assets, if you're providing, I don't know, $7,000 or $8,000 a month in income to the family, another $3,700 is a big load to throw on that $2 million. You can run into a situation where you're very vulnerable to asset depletion, and that's not something anybody wants to get into.
No, if you're 59, like our caller here, or rather our viewer here that sent in the question, and you have not addressed long-term care, you're sticking your head in the sand, so to speak, about that. Don't do that any longer. You have to stop ignoring the long-term care piece to your retirement plan and make sure you've addressed it and made a plan for it wherever you land, whether it's self-insuring or a long-term care insurance policy. This is the question of the week. Thanks to Gary for sending that in. And we will send you, Gary, a free Get Ready for the Future show tumbler for being named the question of the week. Just email us to claim it. Send it to show@getreadyforthefuture.com. Next up, it's Joanne in Benton. I'm 65 and have $3.7 million. I figure with family history, I've got around 20 more years to live. How much should I realistically spend on a house? I have no other debt and don't expect any sort of windfall anytime soon. Thanks, Joanne. Well, certainly with $3.7 million, you're in a situation where you can most likely go buy that house. But I think still doing it prudently and very wisely is key. And I think we'd have to ask a few questions of Joanne. First of all, why do you want a new house?
Right.
Are you a current homeowner? We're assuming at 65, this is probably not a first-time home purchase. So you'd have some equity that would carry over. And if you don't have any debt right now, I'm assuming that you're planning to pay all of that, pay for the house outright up front. So if you're downsizing, that may be a very easy thing to do. If you're upsizing, you may be looking at some of these assets and planning on using some of that to pay for the house. And that would be the first step to really being careful as you walk through this, because where is that $3.7 million? What type of accounts is it? It's just like the previous question we had earlier, John, that you really have to watch out for taxes.
Yeah, you know, you take a $400,000 or $500,000 house. I don't know what size house Joanne is looking at, but even if you said $1 million house, think about the taxes on that withdrawal on top of the income that you're already drawing. And then I think there has to be sort of an analysis of, okay, how does that impact my ability to continue to pay income to myself? Now, that $3.7 million that she has likely could fund a monthly payment on a house, and you may be in a lot better shape by not, impacting the taxes in such a huge way in one lump sum, because when you are retired, that also throws you into IRMA as far as Medicare is concerned. IRMA is the kind of the bad thing about Medicare, that it's means tested. And so if you have a high income, then they're going to bump up your premiums pretty significantly every month. And then you have to go back to the government, prove, okay, that was just a one-time, one-year thing that my income was that high, and get those premiums lowered back down again. It's a big hassle. You probably don't want to do that. You probably also don't want to pay that additional tax burden if you are taking a huge lump sum, as opposed to just building that monthly payment into your cash flow that you're already taking.
Yeah, and one other piece for Joanne here that I would sit on for just a minute too. She says that she figures with family history, she's got about 20 years to live, which would take her to 85. Estimating life expectancy is certainly complicated. Family history is a piece to that, but you should make sure to plan for a long life. You know, I tell clients in the meeting room often, it is better to plan for a long life and not get it than to not plan for a long life and get it. So having this cutoff in your mind of I'm only going to live 20 years, you certainly want to be careful and not plan to that 85.
Scott, that's one of the biggest debates that we have in terms of talking to people about their retirement income. They go, I want to use some of this money while I'm young, and I agree with that. I think that makes a ton of sense. But the thing that you don't want to be into is a situation where you deplete your assets and all you have is Social Security to live on late in your life. Or you have to start selling assets that you have, like sell your house and downsize to an apartment or something of that nature. Those are not things that you desire to do. So you have to be careful and actually go through a bit of a balancing act to understand the impact of lump sum withdrawals on how that allows you to maintain the income. And when I say the income, I'm really talking about your dignity and your independence in retirement, that you don't spend all of that on the upfront, and you enjoy yourself. Obviously, buy the house that you want, but do it prudently as opposed to doing it and just saying, I'm just going to pay cash for it and that's it.
I know a lot of our listeners get the Get Ready for the Future show on radio and on podcast. Did you know we have a YouTube channel? Want to invite you to subscribe to it for exclusive content you can't find anywhere else to help you discover, protect, and share true financial independence. Just search for GenWealth Financial Advisors on YouTube and subscribe to our channel. Just another way to get more education and more information from the team here at GenWealth. Our final question on the show today is from Martin via email. I want to retire comfortably, but I'm worried I've waited too long for that to be possible. I'm 43 and only have about $250,000 in all my retirement accounts. What advice can you give me to try to retire well? Love this question to end on, John, because we've had a $3.7 million net worth. We've had a $2 million net worth. There may be a lot of people out there going, oh, that's not me. I'm never going to be that. Can I even do this? And Martin is right there, right? $250,000 at 43. There's probably a lot of people watching and listening that are in that same position as Martin going, I don't know what to do. I don't know if I'm going to make it. Well, the first thing I would say to Martin and anybody else out there in the same position, you have not waited too long. At 43, Martin still potentially has 2 decades of work life and contributions left to grow that nest egg from $250,000. As long as Martin doesn't want to retire tomorrow or in the next 3 or 4 years, there's still plenty of time.
Scott, you've got to remind Martin about the rule of 72
Yeah.
and use the rule of 72. This is a mathematical formula that basically gives you a general idea. It's not a guarantee or anything of that nature, but is a general idea about how money works. And if you take the rule of 72 and apply it to Martin's situation, he's actually going to do pretty well. He's got $250,000 right now. If Martin gets a 10% return on average on that $250,000 over the next 20 years, and you go 10% return, how's that possible? Well, the S&P 500 has averaged about 10% over the last 20 or 30 years, long-term average. And so by investing it properly, you can get a double-digit return like that. That return is hypothetical. It's not representative of any type of investment per se, but the S&P 500 as a proxy for the stock market has had a track record of averaging in that 10% range. All that being said, if you think about what Martin is doing here, is if he just takes that $250,000, he could have $2 million by age 65 if he just allows that to be invested properly, leave it alone, and let it grow. Now, that doesn't mean anything about what Martin could add to it in terms of accumulating additional dollars.
Yeah, and I say this often too, John. I become a firm believer in the number one thing you can do to create true financial independence is to create margin in your life. And by that, I mean a spread between your income and your expenses. And I think that's the question for Martin. Where is that margin? Do you need to increase income? Do you need to lower expenses? Do you need to do both? Because that's where you're going to get the cash flow to increase your contributions. And I would even say max out your retirement contributions, whatever. We don't know what options Martin has, but if he's got a 401k and he's closing in on age 50, by the time he gets to age 50, it's going to be higher than that by the time he gets there. But right now, someone turning age 50 can get over $30,000 into their 401k.
Yep.
And that does not exclude them, John, from potentially still on the outside of that contributing to a traditional or Roth IRA.
Scott, I'll tell you, another thing that could happen here is that if Martin is industrious and he creates a little side gig, he could throw a ton of money into that retirement because he's not living on that money now. And so if he added even $1,000 a month in a side gig, that's a huge boost to his trip down financial independence territory. And I think that another thing that Martin's got to do here, Scott, is he's got to be sure to control his mindset because he's come at this from the standpoint of, I think I might be too late. It is not too late. You have to bow up on this thing, as I like to say. You've got to keep a proper perspective on things like market variations and not allow a recession that's likely to come along in the next 20 years. Almost assuredly, we're going to have a recession. I don't know when. People have been talking about it for the last 3 or 4 years. Yep. I don't know when it's going to happen, but it's going to happen. But you have to keep the right perspective on that recession and understand what you're doing. If you're accumulating money into your retirement account, you're actually buying more shares than you could have bought if the price were higher. And that price will eventually at some point in time go back up more than likely. So you've got to understand kind of the dynamic of what you're working with here. But the main thing that I want to say is that it's really all about your mindset, your determination, and your focus. And I think that's where a financial advisor could do Martin a lot of good, to be that coach, to come alongside him and be that voice in his ear, that reasoned voice that really does kind of cut through all of the noise that Martin might hear otherwise about his effort to become financially independent.
You know, we sat in on a call with First Trust advisors earlier this week, and they're a partner of ours, an investment company. You can go out and look at them online, but we use some of their investments in our clients' portfolio, and we were getting their outlook from their equity strategist about what to look for in 2025, you know, and their expectations are dampened a little bit compared to the last 2 years where we've accelerated north of 20% returns in the S&P 500. But he went through all the particulars about why things might be slowing down and where there might still be some opportunities, and it may have been in his mind sounding a little negative, and he ended it with this. He said, but stay invested. Don't get out of the market. And to your point, he was saying, he said he's been in the business for 30 plus years and he's never talked to anybody who got out of the market and was able to find the right time to get back in. So that mindset is critical. We're going to have a downturn, but for people in Martin's situation, people who are even closing in closer to retirement, you can't afford to let that drop you out of the market, take you out of the market, because his point was, when are you going to get back in? Because it's going to start going up and you're going to go, oh, maybe it'll go back down again and then I'll get back in, when then it never does. Yeah.
And people who try to time the market generally are going to lose that bet because there is no rhyme or reason to it. The without a doubt, and I know it sounds boring and it's not, anything that's real sexy or anything, but what you want to do is you just want to stay the course and stay invested. People, time and consistency in your actions and in your plan are going to help you drive financial independence more than just about anything else that you could do.
Martin, thanks for the question. We hope our answer was useful for you there. We thank everyone who sent in a question today, and we're going to tell you at the end of the show how you can send in your questions. But first, you heard the bell in the background, and it's time, John, for our final thoughts.
Scott, I want to tag on to the situation with Martin. Martin, what you really, I think, need to do is sit down and create a plan. That plan is going to tell you how much you need to contribute. That plan is going to tell you how you need to invest those assets that you currently have to maximize the return that you're looking for to be able to attain the goal that you're looking for, how much growth you need, where your asset level will end up in retirement. Think about how much income you're going to need in retirement. There's a lot that has to go on here, and that's how we at GenWealth help people find, discover, protect, and share true financial independence. It's putting that plan together and then walking with them with that plan along the way.
Yeah, when folks send in these questions, we're going to give you some action steps. We're going to give you some things to think about. And everybody else listening along the way who is very much similar in a situation, very similar to the people who are asking those questions. But the reality is a comprehensive plan cannot be done by asking a question on a radio show. You've got to come in and build that with a trusted trusted financial advisor. And we have a special offer in the month of January. We're offering a free Social Security analysis. So that's one piece to the overall plan. But we'd love to talk to you if you just have some questions about when should I take Social Security? Is it going to be there? How does it fold into my other retirement assets? You can call us at 866-653-PLAN. That's 866-653-7526 and ask to speak with a financial advisor here at GenWealth. Or you can email us, info@getreadyforthefuture.com. And that is all the time we have for this week's Get Ready for the Future show. As promised, if you want to get a question to us, just send us a text. The number is 501-381-5228. You can also call that number, 501-381-5228. Leave a voicemail, and we'll get your question on the air next week. See you then.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.